JEPI and JEPQ have become two of the most talked about income ETFs in the market. They pay monthly income, they have attractive headline yields, and they offer stock market exposure without looking exactly like a basic index fund. So the big question for 2026 is simple. Are JEPI and JEPQ still worth buying, or are investors sacrificing too much upside without realizing it? That is the real trade-off. Covered call ETFs can look like free income at first, but they are not free income. The income comes with a cost. You may receive monthly distributions, but you may also give up part of the upside when the market runs higher. You may get a smoother ride in some environments, but you can still lose money when stocks fall. And in taxable accounts, the income may not be as efficient as it looks. Covered call ETFs are not free income. They are income with a trade-off. So before deciding if JEPI or JEPQ fits your portfolio, we need to understand what these funds actually do. A covered call ETF is usually built around a simple idea. The fund owns stocks. Then it sells call options. By selling those options, the fund collects option premium. That premium can help support income distributions to investors. That is the basic concept. But the trade-off is important. When a fund sells call options, it may give up part of the upside if the stocks rise strongly. That is why covered call strategies can generate income, but they may lag in strong bull markets. JEPI and JEPQ are often discussed as covered call style income ETFs, but they are better understood as equity premium income ETFs. They use options and equity-linked note strategies to generate income while still maintaining equity exposure. So the strategy is not magic. It's not a dividend machine that creates money from nowhere. The income comes from selling upside, not from magic. That is why the next step is understanding how the trade-off behaves in different markets. The covered call trade-off depends a lot on the market environment. In a sideways market, the strategy can work well. Stocks are not rising too fast. The option premium can create useful income, and investors may feel like they are getting paid while waiting. In a strong bull market, the story can change. If stocks rise quickly, covered call ETFs may collect income but leave some upside on the table. That can frustrate investors who expected the ETF to keep up with a pure growth fund. And in a falling market, income can help soften the ride, but it does not eliminate losses. These are still equity-linked strategies. If the underlying stocks fall, the fund can fall too. So the strategy may reduce some volatility, but it does not remove market risk. Covered call ETFs can smooth the ride, but they can also cap the climb. That trade-off is exactly why JEPI and JEPQ became popular, especially with income-focused investors. JEPI and JEPQ became popular because they promise something investors love: monthly income with equity exposure. That combination is powerful from a marketing standpoint. Investors like cash flow. They like the idea of receiving income every month. They like seeing a high yield. And many investors want something that feels less volatile than simply owning the market. JEPI had $44.75 billion in value of investments as of June 30, 2026. JEPQ had $40.66 billion. That shows how much demand there is for this type of income ETF. But popularity does not remove risk. A fund can be large and still have trade-offs. A fund can have a high yield and still underperform on total return. And a fund can pay monthly income while still exposing investors to equity market losses. JEPI and JEPQ became popular because they promise something investors love: monthly income with equity exposure. Now let's break them down one at a time, starting with JEPI. JEPI is the JP Morgan Equity Premium Income ETF. It is designed to provide current income while maintaining prospects for capital appreciation. It generates income through the combination of selling options and investing in U.S. large-cap stocks. As of June 30, 2026,
JEPI had $44.75 billion in value of investments. Its gross and net expense ratio was 0.350%. Its 30-day SEC yield was 8.20%, and its 12-month rolling dividend yield was 8.06%. Those are attractive income numbers, but the role of JEPI matters. JEPI is built for income first, not maximum upside. It may appeal to investors who want equity exposure, monthly income, and a strategy that seeks lower volatility than the broad large-cap market. But investors need to remember the trade-off. Income can vary, upside can be limited, and the fund still carries equity risk. JEPI is built for income first, not maximum upside. Now, let's compare that to JEPQ, which has a more growth-sensitive profile.
JEPQ is JP Morgan Nasdaq Equity Premium Income ETF. It also seeks current income while maintaining prospects for capital appreciation. But the exposure is different. JEPQ is tied more closely to Nasdaq-oriented growth exposure. That means more sensitivity to technology and growth stocks. As of June 30, 2026, JEPQ had $40.66 billion in value of investments. Its growth and net expense ratio was 0.350%. Its 12-month rolling dividend yield was 10.69%. That income potential is higher than JEPI, but the risk profile is also different. JEPQ may offer more upside potential when growth and Nasdaq-style stocks are doing well, but it can also be more sensitive to growth stock volatility. It may appeal to investors who want income but still want exposure to a more growth-oriented part of the market. JEPQ offers higher income potential, but it also carries more growth stock sensitivity. So the real comparison is not only JEPI versus JEPQ by yield. It is JEPI versus JEPQ by risk profile. JEPI versus JEPQ is not just a yield comparison. It is a risk profile comparison. JEPI is broader. It focuses on U.S. large-cap equity exposure and aims for income with a more defensive profile. Its 30-day SEC yield was 8.20%. Its 12-month rolling dividend yield was 8.06%. JEPQ is more Nasdaq-oriented. It has more growth and technology sensitivity. Its 30-day SEC yield was 12.87%. Its 12-month rolling dividend yield was 10.69%. So if an investor only asks which one pays more, the answer may look simple. JEPQ pays more based on those yield figures, but that is not enough. The better question is, which risk profile fits the job I need in my portfolio? JEPI may fit a more defensive income role. JEPQ may fit income with more growth stock exposure, but neither should be judged only by the yield. JEPI versus JEPQ is not just a yield comparison. It is a risk profile comparison. Now let's talk about when covered call ETFs can actually work well. Covered call ETFs can make sense when income matters more than capturing every point of upside. That is the key. They may work well in sideways markets. They may work well when volatility is moderate or elevated. They may work for investors who want cash flow. They may be useful for retirees, pre-retirees, or investors in the withdrawal phase. And they may fit investors who accept that they are trading some upside for income. This does not mean every investor should own them. It means the strategy can be useful for a specific goal. If your goal is income from an equity-linked strategy, JEPI or JEPQ may be worth studying. If your goal is maximum long-term growth, the trade-off may not be attractive. The problem happens when investors buy these funds for income but secretly expect them to behave like the fastest growth ETFs in a bull market. Covered call ETFs can make sense when income matters more than capturing every point of upside. And that leads directly to the next question. When can JEPI and JEPQ disappoint? JEPI and JEPQ can disappoint when the market runs hard. That is especially true in a strong bull market. If the Nasdaq is surging, JEPQ may participate, but it may not capture every point of upside.
If the S&P 500 is running higher, JEPI may collect income but still lag a simple broad market ETF. That is not necessarily a failure, it is the trade-off, but it can feel like a failure if the investor did not understand the strategy. These ETFs may also disappoint younger investors who are trying to maximize growth. They may disappoint investors who only looked at the yield. They may disappoint investors in taxable accounts who did not think about after-tax returns. And they may disappoint investors who expected the distribution amount to be perfectly stable. Distributions can vary, income is not guaranteed at the same level, and total return still matters. If the market runs hard, covered call ETFs may collect income while leaving upside on the table. That is why the next risk is so important. Yield is not the same thing as total return. The first major risk is misunderstanding yield. A high yield can feel like a win. It can feel like the investment is working because income is coming in. But total return is different. Total return includes the price change plus distributions. If distributions are high but NAV is under pressure, investors need to understand what is really happening. Income is one part of the return. It is not the entire return. That is why comparing JEPI or JEPQ only by yield can be misleading. A fund with a lower yield may deliver stronger total return in some markets. A fund with a higher yield may still disappoint if price performance is weak. A high yield can feel like a win while total return tells a different story. And once you understand total return, the next issue is taxes. This is the kind of ETF analysis we focus on at Boring Money Wins. Not just chasing the highest yield, not just assuming monthly income means free money, and not just comparing ETFs by one headline number. The goal is to understand income, risk, taxes, total return, valuation, and portfolio role. If you like no-hype ETF analysis that explains both the upside and the downside, hit the like button and subscribe to the channel. It helps the channel grow and it tells YouTube to show more practical investing content to people who want income investing without the noise. Now, let's continue with one of the most ignored parts of covered call ETFs, the tax side, because the yield you see is not always the income you keep. The second major risk is tax drag. Covered call and equity premium income strategies often distribute frequent income. That can be useful if you need cash flow, but in a taxable account, those distributions may create taxes. The important number is not just the yield you see, it is the income you keep after taxes. That can change the analysis. A strategy that looks attractive before taxes may look less attractive after taxes. This is why account type matters. A taxable brokerage account is different from a traditional IRA. A traditional IRA is different from a Roth IRA. A Roth IRA is different from a 401k. And tax treatment depends on the investor's personal situation. This is not tax advice. It is a reminder that income strategies do not work the same way in every account. The yield you see is not always the income you keep. And beyond taxes, there's another risk that affects investor behavior: limited upside. The third major risk is limited upside and investor behavior. Selling calls can cap gains. That is a basic trade-off. The fund receives premium, but it may give up part of the upside if the market rises strongly. This can create frustration. An investor may love the income when the market is flat, but then a bull market starts. Growth ETFs run ahead. The Nasdaq runs ahead. The S&P 500 runs ahead. And suddenly, the income ETF feels disappointing. That is not always because the fund failed. It may be because the investor bought an income strategy while expecting growth stock returns. That mismatch is dangerous. The strategy has to match the goal. If the goal is monthly income with equity exposure, the trade-off may make sense. If the goal is maximum long-term growth, the trade-off may not make sense. The biggest risk is not just the ETF. It is buying an income strategy while expecting growth stock returns. So who may actually consider JEPI or JEPQ in 2026?
JEPI and JEPQ may make sense for certain investors. Income-focused investors may consider them. Retirees or pre-retirees may study them. Investors who want equity exposure with monthly income may find them useful. and investors who accept giving up some upside in exchange for income may see a role for them. But that fit is not universal. They may not be ideal for a young investor trying to maximize long-term growth. They may not be ideal for someone who only cares about total return. They may not be ideal for someone who does not understand options, equity-linked notes, taxes, or variable distributions. And they may be dangerous for someone buying only because the yield looks high. JEPI and JEPQ are tools. They are not default portfolios. That is the most important way to think about them. A hammer can be useful, but you do not use a hammer for every job. JEPI and JEPQ are tools, not default portfolios. Now let's finish with the final verdict.
So, are JEPI and JEPQ still worth buying in 2026? The balanced answer is they can be worth studying, but only if you understand the trade-off. JEPI may be useful for investors who want a more defensive, income-focused equity strategy. JEPQ may be useful for investors who want income with more NASDAQ-oriented growth exposure. But neither fund is magic, and neither fund is a perfect replacement for VOO, BTI, QQQ, bonds, or traditional dividend ETFs. They are different tools. They provide monthly income. They can reduce some volatility in certain environments, but they can also limit upside. Distributions can vary. Taxes can matter, and total return still matters. So the question is not simply which one has the highest yield. The better question is, what job do I need this ETF to do? JEPI and JEPQ can be worth owning when you understand the trade-off. They become dangerous when you only see the yield. And boring money usually wins because boring money usually survives.